In today's show, I'll be revealing a blockchain which has striking similarities to Solana at 80 cents. I'll be showing you why I like this chain, why I think it has potential, and I'll also be touching on some of the issues that Solana's been facing and what I think about the future of the network. It's going to be a massive show. Let's get straight into it. So, we have had a bit of news come out of the market, and I wanted to do a quick market recap before I get into the juicy stuff. Basically, I'm going to recap the market, then I'm going to go into what happened on Solana, give you my thoughts on Solana, and if my investment thesis has changed regarding Sol. And then I'm going to talk about some altcoins, some layer ones that I potentially think could perform well over the next couple of years, including one gem that no one is really talking about at the moment, but probably should be. And then at the end of the show, I'm going to be running you through a little L1 portfolio that I've built to kind of show you how to structure risk in terms of these L1s for optimal reward. Because as we go up the risk curve with these L1s, we need to keep in touch what our portfolio weightings are to ensure we're not absorbing too much risk, but we're still exposing ourselves to enough reward. So let's get straight into the show. There's a lot to cover, and let's get straight into it. So this is a market overview of what essentially happened this week to get you up to speed. Bitcoin has basically been trading around the support of 29,000. Resistance has been strong at the 33K to 35K mark. So we did see a Bitcoin bounce off the 29,500 mark. I said I was opening a long here, which was actually opportunistic timing because we were able to ride this long that I revealed on yesterday's show, roughly up 3%. So I hit it with 7x leverage, which was a 21% play. So that was nice to see a little bit of green from Bitcoin. But now we are approaching this resistance zone at $31,000. Obviously, the next key level is the 32 to 33K mark. If we can find our way up to this resistance, if we can break through, that is going to be positive for crypto, positive for altcoins. However, I am expecting a bit of turbulence over the last couple of weeks. We have tested this level and continuously been rejected and setting higher lows in the process. So we'll see what Bitcoin does. It's going to be a pivotal moment for Bitcoin as a whole going into Friday. We know that there's usually a lot of volatility going into the weekend. So keep your eye open here, and I'll keep you updated on my Twitter if there's any trading plays that I see come out of the forefront here. So Bitcoin's been maintaining support, and risky assets such as Bitcoin have faced difficulties because obviously this week, as I talked about on yesterday's show, the Fed is starting quantitative tightening, which means they're reducing the balance sheet following one of the largest increases in the Fed's history in 2020. So they want to reduce the balance sheet by $45 billion a month. They want to do this by $90 billion towards the end of the year. And obviously this will affect equities, which there's an argument to be made that this is already priced into the market, but I think it's important to note, and we can see that I don't have the chart here, but the whale holdings have actually decreased over the last few months. And we are seeing more Bitcoin come onto exchanges. And this isn't a Bitcoin exclusive phenomenon. We are seeing this with Ethereum as well, with $2.21 billion worth of Ethereum returning to exchanges in the last week, which could be attributed to the coin's shift to proof of stake. Some people may not agree with the proof of stake mechanism. I personally believe it's important for scaling. But amidst some of the rumors that the Ethereum APR would be closer to 1 or 2% rather than the 10% previously advertised, I think there has been a little bit of a sell-off and some more Ethereum is coming onto the market. But I think the major piece of news from the past couple of days was definitely this Solana outage. And it kind of sums up Solana's experience, with one event, because Solana has had multiple issues over the last 12 months. This is the seventh time that the network has actually gone down over the last 12 months, and it spells some issues for Solana. And I just wanted to quickly run through, why I think this could potentially be bad for the long-term growth and adoption of the network, and also give you my thoughts on, whether it has changed my investment thesis or not. Because obviously this, isn't great for holders to see. So we kind of have to analyze this, to work out where we go from here as investors. Do we still DCA into Solana? Do we look for alternatives? This is basically my thoughts on the situation. So Sol's still in beta, and I think that's the first thing you have to remember. They did ship a product very quickly. So they shipped one of the fastest pieces of tech on the market. They shipped one of the most scalable pieces of tech on the market. But the trade-off to that was it was a little bit rushed in the sense, that they released on beta, and I don't think, and maybe this was naive of the team, but I don't think they expected the adoption to happen so quickly. I mean, the Solana chain was doing 12 to 20 million transactions a day, basically a 10x on Ethereum, for a long period of time. And this has resulted in obviously a lot of issues because the tech simply can't handle the mass amount of transaction volume, especially from the NFT space that we've seen. So there are more secure L1s on the market, of course. There are more L1s that haven't gone down, but a bet on Solana isn't really a bet on the network staying up, although that has an impact on the growth. It's mostly a bet on network effect. So we've seen the network grow very quickly. We've seen many users flock to Solana, many developers flock to Solana. I think it's the third most developed on-chain in crypto. So for that reason, we're kind of betting on it for future growth. So although these short-term blips are not good to see, and I think they do have a tangible impact on the chain's adoption, at the end of the day, it still is one of the fastest and most scalable L1s. So although the recent downtime doesn't really alter my investment thesis personally, it probably does impact short to medium price performance. And we have seen this with the recent sell-off in Solana. I think after the outage, we saw a 14% decline in the price alongside a sell-off in Bitcoin. So it does affect price action in the short term, absolutely. And especially after the debacle that happened with Luna, investors seem to be taking more of a risk-off approach following the Luna situation. It's kind of like, well, maybe I can take some capital off the table now, diminish the risk of my altcoin going to zero or failing and, potentially miss out on upside gains. So I think some investors are making the decision to kind of take more of a risk-off approach to some of these pieces of technology that are showing flaws. But I think the issue with these shutdowns is mainly that it erodes Solana's reputation and user base. Now, in my opinion, I see this as the cost of innovation. The fact that they shipped very quickly, the fact that they have such a fast and scalable piece of tech, it's very foreseeable that issues like this will occur. So theoretically, over time, the theoretical frequency of downtime should decrease. So the cost could eventually be worth the reward. But if they fail to stifle such events, if they fail to improve the technology to a place where these downtime events aren't occurring, then other L1s will continue to eat market share. So the cost of innovation does come at the expense of time. And we know how important first mover advantage is in crypto. So time means that Solana is giving a bit of a window now for these other L1s to eat up market share. So the team definitely has some work to do. I think Solana still, has some great elements. It scales on a single global state, so liquidity isn't fragmented between subnets or multiple chains. So if it can scale in its own right, then that's a positive for the chain. We haven't seen many chains have a scaling solution that operates like that. It's very low cost, one of the fastest chains in crypto, the third most developed on chain, a large list of VC backers. And regardless what you think of VC backers, it's a very important constituent of success when it comes, to these crypto projects, especially these L1s that need a lot of funding in order to facilitate development. VC backing is extremely important, both from the marketing side, both from the development side. So it doesn't really affect my investment thesis, what's happened. I'm still continuing to DCA into Sol. I said on the show a few days ago, Solana was part of my DCA strategy. This doesn't really change that. However, I do have my eye very wide open because if this keeps happening, then obviously that's a negative sign that it could start to tangibly impact user growth and user adoption. So what am I doing in terms of Sol? Well, I'm doing a little bit of trading, and I think Sheldon's inspired me a little bit to get my trading boots back on and get involved in this market a little bit more. I actually did open a Solana short at this trend line just before here. If we do break above, I have set my stop loss. So I'm looking for a little bit of a short in the short term, which could potentially lead to a 7% downside. However, if this does break above, then I'll likely be stopped out. So look, this is one you can potentially open. It is risky. Remember, I'm not the expert trader like Sheldon, but I'm giving it a bit of a go because we have been flirting with this trend line a bit. And I feel like if Bitcoin gets rejected around this region here, then some of these alts might be decent shorts, but the market's kind of flipped bullish for the day. So, this is kind of a high risk play, but if you want to take that trade, you can take that trade. And remember, if you are trading, you can sign up for a link in the description for a BYBIT account. And we're offering some pretty nice, rewards to some people that sign up. Rand's been 10xing portfolios on the show. We've also got up to a $4,800 sign up bonus. So if you want to sign up, join in with some of these trades that we're doing, I highly recommend it. BYBIT is the place that I'm doing that. All right. So with the whole downtime on Solana, it's kind of put to the forefront the chains that don't have issues. Because when we look at chains with downtime, I think it's equally as important to look at chains with uptime and chains that haven't seen events that have drastically altered the consensus mechanism. And I kind of wanted to highlight a couple now and then talk about one that is looking like it could be the next Solana as well, and run you guys through some fundamentals there. And it's a chain not many people are talking about. So the first thing is I wanted to give a quick update on Fantom because let's be honest, despite Fantom's downfalls, it hasn't really had any downtime. And the fact that the Fantom Network has done 1 million transactions or more per day for an extended period of time, I think now it's probably around the 800,000 mark. That's a testament to the chain because it's handled a large amount of transaction volume and hasn't really had any downtime. So I think Fantom, in terms of one of these plays that has uptime and hasn't had that many issues, is I think a decent play. And obviously the price has been hit over the last few months. I've been very outspoken about my concerns to do with its lack of VC backing, to do with some of the stuff that's happening internally with the team. However, at the end of the day, I do think that Fantom's tech is very strong. And I made a joke about it. I said I got into crypto for the money and now I'm here for the tech. But in a way, this is true. We have to look at pieces of technology which can scale, because as great as making money in crypto is, those gains aren't going to come if a chain doesn't succeed in terms of its tech and its user adoption, which obviously, relies on the technology being very solid. So I think this is what's really underpinning my conviction in Fantom at the moment. Some of the reasons I previously invested aren't the reasons I'm investing now. Now the reason I'm investing is more to do with the fact that I think this ABFT consensus can actually scale. And I'm betting on FVM being a positive change for the network. Now, yes, it's got issues to do with VC backing, etc. And I'm probably a little less bullish than I was, last year, just because some issues have come to the forefront. But as a bet on pure technology, I think Fantom is a great chain. Now, this isn't the one that I wanted to show you guys in the video. This isn't the gem that I'll be revealing. That's coming soon. But I wanted to talk about a couple chains first that are kind of filling this gap in the market for chains with no downtime. Obviously, you've also got Litecoin, which has had virtually no downtime. The Litecoin maxis have been out in full force at the moment, kind of hating on Solana, using that as an excuse to shield their chain. I don't really have an opinion on Litecoin, but I guess that hasn't had much downtime, so that's a positive. Bitcoin and Ethereum over the last couple of years have held up very, very well. And also back in terms of Fantom, this is some pretty big news that we got over the last day, and that is that the Layer 2 Boba network integrates with Fantom and Moonbeam. So the Boba network is an optimistic rollup. It's a Layer 2 kind of scaling solution, which is now integrating and deploying on Fantom and Moonbeam, which I think is bullish for both of these chains. Now, I'm going to show you a portfolio at the end of the show, which I like in terms of L1s, but on that portfolio, I do have Fantom and Moonbeam, and I think this does add slightly to that case. That integration will help bring increased scalability to Fantom, deliver resources and developers needed to design creative large-scale dApps. Although Fantom can scale in its single state, it's EVM compatible, it's very fast. At the same time, these L2 solutions are a positive. And I think that most chains, if they do accrue the amount of user adoption we think they're going to accrue over the next few years, they're going to need more L1 power. And one way to chip in and help subsidize that L1 power is through L2 solutions like Boba. So having that on Fantom and Moonbeam is a positive for the network. The other chain that has held up remarkably well over the last few months is actually AVAX. Now, I kind of stated my issues with AVAX in terms of it losing a lot of transaction volume as a result of the Krabata network getting its own subnet. But I think AVAX in its own right is still a very good investment. It is using these subnets. It's going after this long-term approach of, yes, maybe we take a short-term hit to transactions and TVL in the meantime, but long-term, we are offering one of the only solutions to scalability on the market that's proven. Because Solana, although its scalability solution, it sounds good on paper, it started to show some flaws when the transactions got very high. Whereas AVAX operating on subnets, yes, this does fragment liquidity, which is a negative for AVAX's token value accrual, so the AVAX token price performance. But at the same time, it does help it scale. And I think the tech is a very long-term bet. And if Emin can kind of execute on this vision, I think AVAX ultimately becomes one of these primary networks, almost like an L0, similar to Polkadot. So I do like Avalanche as well in terms of a chain that hasn't shown much downtime, and the fact that it has 50,000 daily active users is awesome. I showed you guys Near Protocol a few days ago that had 10,000 users. I think Fantom was around that range as well. AVAX has 5x that. So that's pretty impressive considering a lot of this network traffic was diverted onto the subnets. All right, I know all of you guys are here for this gem, so I'm going to reveal it now and talk to you guys through an altcoin that isn't really being that talked about, and I think it's being a little bit slept on, and it's one that I've recently started digging into, and I thought this was an opportunistic time to present this to you guys because Solana went down, and this is essentially a Solana fork with a few major advantages. Now, only 2 people in the comments guessed what it is, but that chain is actually Velas or VLX. Now, I want to explain what Velas is, explain, why I think it could be good, its positives, its negatives, and kind of run through it really quickly. Because basically, the gist of what Velas is it's a Solana fork that utilizes the best parts of Solana's consensus, but also offers EVM compatibility. So it's kind of like this hybrid, and we've seen the technology be pretty effective because it's clocked some of the highest speeds we've seen in crypto. I think it did 75,000 transactions per second on its mainnet, which is pretty impressive, and it has a pretty clear path to scalability. So I do like the Velas technology a lot, and I wanted to come on and talk to you guys a little bit about it today and give you some insight into what I think about it. So essentially, just like other L1s, it's a decentralized blockchain, but it utilizes this artificial intelligence powered consensus to power the network. So obviously, like other L1s, it's home to dApps, decentralized applications, it's home to launch pads, it's home to games, but it also has this artificial intelligent delegated proof of stake consensus algorithm, which makes it pretty unique. Now, the unique thing about the Velas chain is that it's address the issue of scalability by utilizing the best part of Solana. So Solana's consensus is very positive because it can scale on a single global state, as I talked to you guys about before, but it has had issues. And one of the issues with this is obviously the downtime that it's receiving off the back of the mass transaction volume. Now, Velas wanted to take a different approach with this. They wanted to not go through what Solana went through in terms of building up its own ecosystem from scratch. They wanted to utilize EVM compatibility as a way to onboard new dApps and users. So basically, you can use it on a MetaMask instead of having a proprietary wallet like a Fantom wallet on Solana to push through transactions and interact with dApps. So what they're doing is they're using the EVM for scaling, but at the same time, they're using Solana's consensus to complement their AI-powered blockchain. So essentially, it's mixing the best parts of Solana and the benefits of being EVM compatible and putting them together. And as a result, we've seen a 75,000 TPS, which is very, very strong. And I think it could potentially be a network that developers use in the future just because of its speeds. And at the end of the day, tech is what is going to drive a lot of this innovation forward. And I love seeing things like Velas because the tech's very interesting and the approach they're taking is interesting, and it's different to what Solana's taking, although it does fork some of the elements that Solana utilizes. So the native token of the Velas chain is the VLX token. It's essential for transacting throughout the ecosystem. It's a primary unit of payments, just like you'll see on Ethereum. It's basically the gas token of the network, which you can also stake in a validator node to earn yield. So it's very, very interesting because this is kind of like their vision. This is the Velas' team vision. They want to develop a blockchain framework that will be better than existing analogs, and they think it's necessary to implement the entire basic stack of components, believing that it's much more efficient to take existing frameworks and enhance them. So basically, the Velas team started by developing the code from scratch and eventually came to the conclusion that such a project could last for many years at the time when ready-made and high-quality blockchain frameworks already exist in the public domain. After a period of rethinking the process and analysis of the Velas product ecosystem, we've developed the requirements for the blockchain that we need. And these are basically the requirements that the team set out in their white paper. They want high throughput, so more than 30,000 transactions per second. We've already seen that on the chain. They want to be resistant to various types of attacks. I think this is the main thing because obviously if you're forking Solana, you don't want to fall for the same hacks that the Solana network has fallen for. You want to be resistant to these type of DDoS attacks and whatnot. So they're resistant to that. The DPoS consensus is based on VLX tokenomics, which is obviously important because chains that prioritize tokenomics at the end of the day, that's a lot better for holders, and they want to support EVM compatibility. They want to support the Ethereum ecosystem. So this is one of the reasons why I think this could succeed as a chain. Now, just remember, this is very high risk. This isn't a chain that I'm telling you to ape into. And personally, I haven't even bought this chain yet. So anyone saying I'm shilling in the comments, I don't even own this yet. I'm giving you guys this news before I've even built a position. But the reason why I'm considering building a position is because of the $100 million grants program that they've recently launched. Now, we all know that developer incentives are one of the major drivers of growth in crypto. You need incentives for developers to come and build on a chain because that is eventually what is going to attract the users. And we know that the more users the chain has, the more transactions it does, the bigger the network effect, and thus the better the token performs, as the Velas token essentially is the gas token and the token that's needed to be staked. So betting on L1s, basically all L1s in general, it's a bet on future growth. This crypto is highly speculative, and it's pricing in future adoption. Now, how can we achieve adoption? Well, the first thing we can do to achieve that is have quality developers developing on these chains. Now, the $100 million grants program for Velas certainly helps this. And if it wasn't for this program, honestly, I wouldn't even be talking about this on the show today because there's a lot of protocols with great tech in crypto, but great tech doesn't always win out. As important as it is, you do need these incentives for protocols to succeed. So the $100 million program, I think, is what is going to help accelerate this ecosystem. And we've seen it actually partner with the Ferrari team. We've seen it go for real life partnerships as well as crypto partnerships. And you can submit an application if you're a project, which is reviewed by the fund's panel of judges. And basically this incentive program for developers offers development support, mentorship, acceleration, and marketing support. So we're at the very early stages of Velas. And this is something that I want you to put on your watch lists. Maybe it's something we're not aping into today, but it's something we want to have on our radars because these smaller blockchains are really where you get the crazy gains. Yes, they can go to zero because a lot of these smaller chains are going to fail in this bear market, 100%. But if you're willing to take a little bit of a risk with a very small percentage of your portfolio, then we know that these smaller blockchains, I think Velas is around the $200 million mark, we know that they can outperform on the way up. So this is something that I'm adding to my portfolio just a little bit of over the next few months because I do like the tech and I've heard a lot of good things about it. And it's very quick. Using it is very seamless. And that's, one of the major components that I look for when I use a chain. Is it nice to use? And I can say that it is nice to use. So on its DeFi llama, it only has $7 million locked. So I'm literally giving you guys this very, very early. We're at the very early stages of this, a little bit more of a degen L1 play, given its market cap and its relative TVL to market cap ratio. But we're already seeing a decent ecosystem being built out. So considering its TVL is so low, we already have some pretty decent dApps, one of which is Wagyu Swap. I know a lot of people like this. I actually do like this as a DEX. Obviously, we need AMMs, we need DEXs in these DeFi ecosystems to help facilitate swaps, facilitate farming, and offer liquidity. And Wagyu Swap is one that's doing that quite well, in my opinion. And you've got some decent farming options. So these farms are maybe something I cover in the future if you guys are interested in doing a little bit more research into Velas. I'll probably talk about this on the show because I think there are some good opportunities here. Just a few pools that stick out. We have some of these VLX WAG pools. Of course, with DEXs, we know emissions often can kill a DEX, so just be wary of that. In fact, if I look at the Wagyu Swap tokenomics right now, live on the show, hopefully the fully diluted is available for us. So that, the circulating supply is 46. The total supply is 500 million, so still a 10x in dilution to come. If you look at their white paper, and I always recommend doing this when you invest in a new project, you'll be able to see what their emission schedule actually looks like to see when this total supply is going to be hitting the market. Now, I want to talk you guys through a portfolio, an L1 portfolio that I think could potentially perform well and kind of guide you guys down the path of how I personally believe you should be structuring your L1 portfolio. Because, okay, cool. I've given you a gem like Velas, which could potentially perform well, but it also could potentially go to zero. So how can we weight our risk on a token like Velas to ensure that we're maximizing upside while minimizing downside? Because at the end of the day, we still are in a bear market, so we can't get too carried away with these crazy degen plays. So how can we tweak our risk profile? Well, the first thing is to take consideration into the percentages that you're allocating. So I built a little bit of a portfolio here, and this is my layer 1 portfolio. So a couple things to note. This doesn't include Bitcoin and Ethereum, because I view them as the top dogs in the market. Even though Ethereum's an L1, it's in a separate section of my portfolio. This doesn't include any other types of coins, so it won't include a Rune or a Stargate or a Frax or any other token, because this is a pure L1 portfolio. And it's not going to include the layer zeros like Dot, Atom, etc. It also excludes BNB and ADA, which are the safer plays. Of course, you can add these if you like. But this is a slightly more risky L1 portfolio that will make up a subset of your portfolio. So I'll run through it in a second and talk you guys through, why I like some of these projects, and talk you guys through the percentages and justify my logic here. So the first thing to note is that an L1 portfolio like this is a subset of your broader portfolio. So it may only constitute 30% of your total portfolio. Is likely 40% plus will be allocated to Bitcoin, Ethereum, potentially some layer zeros, Dot, Atom, BNB, maybe ADA. So those will constitute the large part of your portfolio, but then you'll have maybe 20 to 40% in that range, depending on your risk tolerance, allocated to L1s, because at the end of the day, L1s are still going to be some of the best performers in crypto. I believe that they're still probably the best risk reward plays. I could make an argument for some picks and shovels in DeFi ecosystems being great risk reward plays, but at the end of the day, these L1s are what historically has performed very well, and we know that they're the backbone of these DeFi ecosystems. So we limit a little bit of risk by investing in L1s versus the ecosystems directly, because something like, let's say, an AVAX, if the overall ecosystem develops, the AVAX token will likely accrue value, and you're not betting on some of the riskier ecosystem tokens underneath it, in order to, in the pursuit of growth. So these layer 1s, I think, do represent decent risk reward plays. So given the disclaimers I've written here, this is a portfolio that I'd maybe look at. Now, Solana, yes, obviously it has had some issues, as I pointed out, but as my thread also established, it doesn't really change my long-term investing strategy. So I don't see a reason to be rash and stop DCAing into Solana. So it constitutes 25% of my portfolio. AVAX, which I view as a blue chip, it's a very long-term play with its subnet scaling solution. I've had this at 25%. Now, Near Protocol, one of my higher conviction L1 plays. This is what I would classify as emerging. And I really like this because of the VC backing, because of the development in the ecosystem, because it already accrued $1 billion in TVL in a very short amount of time. I think Near Protocol is one that has the tech and has the funding to succeed. Therefore, I put it in as 20%. And then this is where things get interesting. This is where you can have a little bit of fun with your L1s. Fantom, for example, it's a medium risk L1. So it's a much lower market cap. I think it comes in at around 700 million at the moment. But it has that upside because the tech is great. So yes, it can potentially go to zero, but I think that's unlikely because of the community that has been established underneath it, and the technology is solid enough for it to warrant a 10 to 15% portfolio weighting amongst these L1s. So I have Fantom in it at 15%. I have Moonbeam, which is obviously the main EVM compatible L1 on Polkadot. I have that in at 5%. Because I believe that that's a very good risk reward play due to the market cap being extremely low, and there's already been a major sell-off on Moonbeam. So we've seen, in my opinion, the worst of the sell-off in percentage terms for Moonbeam. Although, of course, if this market continues, to go down, if we do test these 24 to 27K levels again, then altcoins are going to get hit. So remember to DCA, remember to keep stables on the side. But Moonbeam is definitely one that I'm looking at, because, a market cap of 374 million for the main EVM L1 on Dot is a pretty decent play. Moon River, which is the main L1, it's kind of Moonbeam's cousin on Kusama. That's very high risk, but I put it in at 5% because it's got a market cap of like $40 million now. So it's one of those potential L1s with a lot of upside. So I have it in as a small percentage of my L1 portfolio. And then VLX, now you could substitute almost 10 altcoins for these categories, because at the end of the day, it all comes down to personal preference. Some people want to pursue some of the safer ones like BNB ADA instead of Moonbeam. You might like an Elrond. Some people like Algorand, Cadena. I think you can make a case for either one of them. So at the end of the day, a portfolio like this is to kind of push you down the right path of your percentage weightings, not necessarily to tell you these are the exact tokens to buy. But if I were building out a portfolio, it'd be similar to this. And VLX is and that's the Solana fork that I told you guys about today. That is, one of the higher risk plays that, okay, if you lose 5% and it goes to zero, that's okay. You still have 95% of your wealth. If it goes up, you are still in a great position to benefit from the upside. So it's all about risk reward weighting with these protocols. The general rule of thumb here when building a portfolio is the higher risk a project is, the lower percentage weighting, and the lower risk a project is, the higher percentage weighting. Hence why Bitcoin and Ethereum are my two biggest holdings, because they have the lowest risk, so you can afford to outlay more capital, and to get the same size returns, you need more capital. So I kind of view these smaller L1s as leverage longs in a way that you can actually afford to limit your risk because you're putting less capital into them. So you're putting in less capital into a Moonbeam or a Velas than you would be putting into a Solana or an AVAX, but you can potentially still get the same dollar amount return back. Because it's higher risk, so it'll technically pump harder during an upswing. But obviously, you are exposing yourself to more downside as well. So I kind of view it as a leverage long on L1s. So that's why it's only 5% of a 30% segment of my portfolio. So, probably something like a Velas would come out to like 1 to 1.5% of my portfolio, which relatively is very, very low. Just getting a few questions here that I'll quickly address. Return the Luna 2.0 airdrop to your Donkey investors. Just to quickly touch on this, we didn't get an airdrop for the Donkey pool. We have been in contact with the Terra team. We haven't received any airdrop yet. As soon as there's an airdrop, I'll be the first one to come on here and tell you about it. But we did pause the farm for new capital coming in. You can still withdraw. We were lucky enough to cash out before UST went to zero, but obviously we still did take a hit on that farm. I'll need to look into the realized loss numbers to give you an exact update on that, but for people asking about that, that is the response. A lot of comments here are saying, like, what about DOT? What about Atom? What about Pulse Chain? As I said before, DOT and Atom aren't included in this portfolio because I consider them to be layer zeros. Some people like Cadena, some people like Elrond, and I have no problem against that. At the end of the day, L1s, there are so many of them, and you have to make a choice based on what your beliefs are as an investor. I like to go for the more EVM compatible type chains because I'm more focused on user adoption and DeFi. Hence, why I do like the Fantoms, why I do like the Moonbeams, why I do like VLX, but I also want to have a few pieces of interesting technology amongst my portfolio that can scale in ways that other chains don't. For example, Solana and AVAX have unique approaches to the scalability trilemma. So, those are a couple of plays that I have in for that reason. But you do have to realize that with these smaller market cap L1s, they can pump a lot harder, and that is exactly why they're smaller percentages of the portfolio. Like if a Velas went to the same market cap as a Solana, which I think it never will, by the way, but that's a 94x. So look, if somehow it did, gain even 10% of the traction there, that's a 10x. So it's very important to kind of look at these comparisons to work out how to frame your risk reward profile, because if it does 100x to get to Solana, then if you have 1% of your Velas, if your portfolio is 1% Velas, then that's going to constitute a 100x rise in the Velas price, which essentially has a major impact on your portfolio. It can potentially double your portfolio just from 100x move. Now, I'm not saying necessarily it'll do that because it's a very highly it's a riskier L1, a riskier altcoin, but risk reward is the most important thing in crypto. And if you're watching Sheldon's live trading shows, you'll know that we're using leverage as a tool to limit risk, not increase it. And we're being very strict with our stop losses. And we are basically getting exposure to more capital through leveraging, but we are decreasing our risk because we're putting up less capital. So when you're investing in L1s, it's actually a similar theory. It's that these lower caps, they are more risky, but they are offering more upsides. That's why you can afford to put less capital in. So I don't think necessarily there needs to be this hate between should we invest in this or this. There's always room for multiple coins in your portfolio. It's not a question of like Cardano or Solana. It's a question of like what percentage do I want to allocate to both, while maintaining a well-diversified portfolio that isn't diversified so much that you're spreading too thin, but it's well-rounded enough that you're not risking yourself to one particular point of failure like we saw in a lot of portfolios that were highly skewed towards Luna. So just to summarize, I think Velas is a good play. It's a Solana fork. It has EVM compatibility. It has a $100 million grants program. It is risky, but at the same time, it's one of these I've got my eye on. I don't own any yet, but it's one I'm looking at adding to my portfolio in the near future. And maybe I'll do some more videos on Velas DeFi in the future. Fantom still looking good. Moonbeam still looking good with the new Boba deployment, the L2 optimistic roll-up deployment on those chains, and the market in general is still kind of trading on shaky ground, although we are seeing a little bit of push up from this trend line from Bitcoin. But going into the weekend, I think we are going to see some volatility. So all eyes on the Bitcoin chart right now. I know a lot of you guys have questions, and you're asking questions that you want me to answer. So I do want to go and answer them. So I'll be going on to my Instagram now. If you click one of the links in the descriptions, I'll answer some of the questions live on my Insta. And I'll also follow some of you guys back, following me on my Insta. So yeah, let's go over to Instagram right now, have a little bit of a conversation. I'll follow some of you guys back for following me, and we'll have a bit of a chat and a Q&A over on Instagram. So I hope you guys enjoyed the show. Thank you so much for the support. It's been a great week of content. And I'll see you guys in the next one. Peace out.